Let me ask you something. If a stock market crashes on the other side of the world, does it actually matter to you? 3 weeks ago, South Korea's stock market was the best performing major market on the planet. It had gained roughly 60% in 2026 alone. Two companies, Samsung and SK Hynix, made up more than half of that entire market. And then in less than a month, it lost about a quarter of its value. Here's the twist. The thing that just broke Korea's market is sitting inside your own portfolio right now. You just don't know it yet. So let's actually look at what happened. Most people heard about the Korea crash and filed it under not my problem. Different country, different currency, different rules. And get this, that assumption is exactly backwards. South Korea and the United States were running the same trade. Korea was just running a smaller, faster, more concentrated version of it. Which means what happened there over 21 days is basically a preview, in fast forward, of a risk that's still building here. Let's start with the setup. South Korea has about 51 million people. Roughly 14 million of them are active retail investors. They call themselves ants. One ant alone doesn't move anything. 14 million of them, moving together, can move an entire market. Why were so many ants piling in? Because home ownership in Korea has drifted out of reach for a lot of young people. The traditional path, good job, house, family, stopped being realistic for that generation. So the stock market became the last available way to build wealth. And a lot of them didn't just invest. They leveraged. They took out loans against their salaries to buy stocks. Many of them didn't even buy plain shares. They bought leveraged ETFs, funds that multiply the market's daily move. A 2x fund turns a 1% gain into 2%. It also turns a 1% loss into 2%. At the peak, Korean retail money poured roughly 10 trillion won into leveraged funds betting on a single company. And nearly all of that leverage was aimed at the same two names. Samsung and SK Hynix make memory chips. Together, they account for around half of Korea's entire stock index. For comparison, the S&P 500 has 500 companies spread across the index. Korea's index, in practice, behaves like a two-stock market wearing a 100-stock costume. Now here's the part that connects Korea to you. Why did those two stocks rip higher in the first place? AI data centers need memory chips. Samsung and SK Hynix are the two companies that dominate that supply. American hyperscalers, Microsoft, Google, Amazon, and Meta, spent around $410 billion on AI infrastructure in 2025. In 2026, that combined number is on track to hit roughly $725 billion. A huge share of that spending flows straight into Korean memory chips. So Korean retail investors weren't just betting on two Korean companies. They were making a leveraged bet on American AI spending through a two-stock proxy with borrowed money. That is how, by June, Korea had built the most concentrated major stock market in the world, propped up by retail leverage, riding on the back of one trade, continuing forever. So what actually broke it? In late June, US chip stocks got nervous ahead of Micron's earnings. Micron is Samsung and SK Hynix's American competitor. When US memory names wobbled, the same fear hit Korea, except with far more force. The KOSPI dropped nearly 9% in a single session and tripped a circuit breaker. SK Hynix fell over 15% in one day. Samsung dropped more than 10%. A week later came another session Koreans are now calling Black Monday, where the index shed close to 9% again, and SK Hynix posted its worst one-day fall in almost 2 decades. Peak to trough, the KOSPI lost around 25 to 31% of its value. For context, a drop like that in the US would rank among the worst days in American market history. Now here's the mechanism that turned a sell-off into a collapse. In a normal market, a drop ends when sellers stop selling. But when a market runs on borrowed money, nobody has to choose to sell. The selling happens automatically. When a leveraged stock falls to a certain price, the broker issues a margin call. Deposit more cash by morning. Or the broker liquidates the position at whatever price the market offers. They don't wait for a better price. They don't care that the investor is down 40%. They just execute. As of mid-July, more than 1.2 million Korean retail accounts had triggered margin calls. That's roughly 1 in every 30 adults in the entire country. Somewhere between 320,000 and 360,000 accounts were forcibly liquidated. Some of those accounts were wiped out overnight. Normally, about 2% of margin accounts get force liquidated in a rough month. During this crash, that rate jumped above 10%. Leveraged ETFs made it worse because those funds have to rebalance every single day. On a big down day, the fund itself is forced to sell into a falling market just to hold its leverage ratio steady. So retail investors were getting liquidated, and the funds sitting on top of them were forced selling at the same time. Every sale made the next one more likely. It spread past Korea within 48 hours. Asian markets lost hundreds of billions of dollars in value. Japan, Taiwan, and Hong Kong all fell alongside it. South Korea's central bank raised interest rates for the first time in 3 years. Regulators banned new leveraged single-stock products and tightened margin rules. The country's own president, who had spent the past year encouraging citizens to invest, had to step in to try to calm the panic. So that's Korea. Now let's look at the number that should actually worry you, because it isn't a Korean number. It's American margin debt, measured as a share of the entire U.S. economy. Every time this number has spiked to an extreme in history, a major correction followed close behind. June 1968, right before the market lost a third of its value. August 1987, 2 months before Black Monday, the worst single day in stock market history. March 2000, the exact month the dot-com bubble peaked. 2007, months before the financial crisis. 2018 and 2021 were both followed by sharp corrections. As of June 2026, U.S. margin debt sits at roughly 4.7% of GDP. That is the highest level ever recorded, higher than the dot-com peak, higher than 2007, higher than the 2021 meme stock era. And that number is actually the floor, not the ceiling. Official margin data only tracks traditional brokerage loans. It doesn't capture leveraged ETFs, options exposure, or portfolio margin, the same tools that just detonated in Korea. Single-stock leveraged funds tied to names like Nvidia and Tesla are trading at record volumes in the US right now. Zero-day options, where traders gamble on where a stock lands in the next 6 hours, are also at record volumes. Layer on top of that the concentration problem. The 10 largest companies in the S&P 500 now make up more than 40% of the entire index. At the peak of the dot-com bubble, that number topped out around 27%. We are more concentrated today than we were in 2000. And almost all of those top 10 names are making the same underlying bet. AI. Nvidia sells the chips. Microsoft, Amazon, Google, and Meta buy the chips. Micron and Korea's chipmakers supply the memory behind them. Money moves in a loop between a small group of companies, and that loop is what's currently propping up the broader market. Jim Chanos, the investor who first called out Enron, has been tracking this closely. He points out that hyperscalers used to earn about 40 cents of operating profit for every incremental dollar they spent on AI infrastructure. Today, that number is closer to 20 cents, and it's trending toward 10. His own estimate is that the reckoning point, if there is one, lands somewhere between late 2026 and 2027. There's a historical precedent for what happens when a capital expenditure story reverses. In 2000, Coca-Cola ordered 10,000 routers from Cisco. By 2001, that order had shrunk to 2,000. Coca-Cola barely noticed the change on its own books. Cisco's earnings collapsed, and the Nasdaq eventually fell 78%. A supplier's fortune is built entirely on someone else's spending decision, and spending decisions can reverse in a single earnings call. Now, to be fair, it isn't all one-sided. There's a real counter-argument, and it's worth putting on the table. Goldman Sachs has pointed out that this year's wave of IPOs looks nothing like the dot-com era. Back then, hundreds of unprofitable companies with no real business model rush to go public. This year, total new equity issuance is tracking below the historical average as a share of the market, and the companies going public, like SpaceX, actually generate real revenue. Samsung and SK Hynix's underlying demand hasn't disappeared either. Their forward earnings have grown even faster than their share prices, meaning valuations on paper look less stretched than the raw price charts suggest. Some analysts genuinely believe AI infrastructure spending still has another 6 to 12 months of runway before any of this needs to slow down. That's scenario 1. Korea stays contained to Korea. Hyperscaler spending keeps climbing through 2027, and the KOSPI eventually recovers. Scenario 2 is that Korea wasn't an isolated accident. It was the first domino. And the trigger for Scenario 2 isn't a memory chip failing to sell. It's simpler than that. It's one hyperscaler CEO, on one earnings call, saying 4 words: "We're reducing capital expenditures." Because right now, in the US, the only reason a handful of massive companies keep justifying record spending is that the stock market keeps rewarding them for it every single quarter. The moment that reward flips into punishment for spending too much instead of too little, the unwind Korea just went through becomes a smaller preview of a bigger one. In April 1912, as reports came in that the Titanic was taking on water, an executive at the company that owned it told reporters they had absolute confidence in the ship. He said the vessel was unsinkable. He said it after it had already hit the iceberg. 3 weeks ago, 14 million Korean retail investors had that same absolute confidence that their market would keep climbing. None of this is a prediction that a crash is coming, and it isn't financial advice. But the numbers sitting underneath the US market right now are not smaller than Korea's. In some places, they're larger. So here's the question worth sitting with. If a stock market crash on the other side of the world can wipe out 360,000 accounts in 3 weeks, and the leverage underneath your own market is now the highest ever recorded, does it actually matter to you?